And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. Welcome to my podcast. Well, quite a day yesterday, and I'm not talking about that ridiculous memorandum that thing's not going to work out. I mean, that's if you got 3 chances of that working out, slim and none. So, but what most people really missed yesterday was a more important story is what the new Fed chair did. I mean, this is amazing. Remember, Trump wanted to fire Powell because he wouldn't cut rates. Amazing. His new Fed guy, Walsh, comes in and he says he's going to raise rates. Raise rates. And he's talking a jump probably from 3.4% to 3.8%. So in other words, the Fed is now hawkish. I mean, where's that coming from? That's a big deal. So what happened this morning, everything started to flip around because everybody's thinking, okay, rates are going to go down. They're going to start cutting rates because we had the hot inflation and no, he's talking about raising rates. So the first thing I told my members this morning, we got to be a little cautious here with the market opening and see how this all plays out. And what was interesting, the NASDAQ goes up 700 points. And people are running around, investors running around like their hair's on fire. What are you, nuts? Like, wow, we got a real big rally going here. It was a nothing burger. All that's happened with that 700 points is you had a rotation going on out of 3 stocks, out of NVIDIA, Microsoft, and Apple, into Amazon, Google, and Meta. The same institutions, also some computers, some bot trading going on, and they identified why should we, what the big institutions saying, why stay in NVIDIA, Microsoft, and Apple when we got a better deal in Amazon, Google, and Meta. And so that is what drove the market 700 points? What are you, nuts? So today's move was nothing but a rotation by institutions, by computers. And that's it. But everybody's making a big deal out of it. So, and the other thing too, people don't understand, traders don't really understand that if you pay attention to what they call the 6 generals. Okay, and I'll get them here for you in a second, put them up for you. The 6 generals. Those stocks are what drives the NASDAQ. And if you stay with those, they're controlled by, as I just gave it to you, Amazon, Google, Meta, and NVIDIA, Microsoft, and Apple. They control the NASDAQ. They control the direction of NASDAQ. A handful of stocks. That's it. So when you see 700 points today, it's not like like the Dow 30 is up 700 points. You got just a few stocks in the NASDAQ. So that's dangerous because what it tells you too is that we could be topping. That's right. We could be topping. So if you look at what happened this morning, we had some sectors should have got hit with what happened yesterday because, again, his announcement is going to raise rates instead of lowering rates. So I told my members this morning that, the stocks that that should get hit, and I gave them three groups. I gave them XLC, XLY, XLU, IWM, VQ. And I said those stocks, okay, should get hit, and they did. So we were right on those stocks. The only one that didn't get hit was XLK, which is your tech. That XLK, I use XLK instead of the Qs. And the ones that should have done well, out of the 6, 3 did. So the point of this is that we have this market right now that, again, is so narrow. So few stocks are driving this whole market, and it gets more dangerous. So the Fed chair, he caused the 10-year and the 2-year treasuries to rise. Yesterday, the 10-year on his announcement went up 5 points. Now, that's no big deal. On a Richter scale, that's out of 1 to 10, this may be a 2. But what really caught everybody's eyes is the 2-year. That increased 16 basis points. 16! That's nuts. That's insane. So what happens is now the yield curve, which most people don't pay attention to, and they should, because the yield curve is what tells us if the banks are going to be profitable or not. And you've got to have profitable banks because the banks are the economy after all. So the yield curve has gotten even worse now. Remember, the yield curve, think of a measure stick from at 0, and it went up to 150. That's where you want to be. 150 is a nice, comfortable deal. It tells you your banks are really healthy, doing good, are real profitable. But we're at minus 44 before this announcement yesterday that again pushed the 2-year. You got to watch that 2-year. The 2 years is the important one because 2-year means everything's going to happen now. So when he made the announcement, he's going to raise rates. And the 2-year yield, that's the one you look at, immediately went up 16 points. That means the rates in the economy going to go crazy, going to go up. So in other words, you're going to be paying more on your credit cards, more on your car loans, business loans, personal loans, adjustable rate loans. You're talking a lot more expense at a time that the consumer's not doing well at all. And that means, too, that the 10-year, okay, the 10-year went up just 5 basis points, but even so, mortgage rates are going to go up. So that was a pretty big deal yesterday. That was bigger than the stupid piece of paper doesn't mean anything that the Iranians are never going to hold on to. I mean, they're never going to keep their promise. Are you kidding me? So that was so dangerous yesterday, and nobody's looking at it. I want you to think about it. The 2-year, that's the reason why the 2-year yield is so important to look at when you're a trader, because that's the one that tells you what's happening immediately now. The 10-year is looking out in the future, but that 2-year, 16 basis points, that's huge. So that is going to really hurt this economy. Now, we all know, too, this Iranian deal is not going to hold. I don't think it'll hold this weekend. I think they'll start bombing each other this weekend. I just don't see how Iran is going to change. So again, when yields rise, especially that 2-year, it's sending a message. Okay, everything gets hit. Tech gets hit, small caps get hit, REITs get hit, utilities get hit. And banks, again, remember, only do well when the 10-year rises, okay, because they make more money. When mortgage goes up, they make more money. And so, but again, when you have that 10-year rising more than the 2-year rising more than that 10-year, that's when it's really dangerous, because that inverts the yield curve. And so our yield curve is getting worse. We were at minus 44. Now we're heading out even further, maybe to 50. So traders this morning were buying bonds because they were worried about growth. Inflation expectations fell. And the stock sectors that will do well, okay, like the banks, we watched them today, okay, and we watched energy, we watched the materials today, industrials, but let's take a look at a couple of the banks here, because these are the ones that are important. So if we look at what happened with, let's get to my bank stocks here. We'll take a look at them for a moment. I mean, this was a serious deal yesterday. Everybody's focusing on this phony deal with Iran, and this thing's going on. Nobody's even paying attention to it. It's just absolutely nuts. It's just absolutely nuts. So, and today it just really showed what happened. I mean, crazy. So all of a sudden now we got a real problem facing us. All right, so let's go down and take a look at. Let's see if we get to our banks here. Here we go. All right. So first of all, here we go. Let's go to the tech stocks first. What happened today? This was interesting as well too. So if you look at Amazon, Meta, Google, Nvidia, Microsoft, Apple, and Broadcom, as they call them, the six generals, because they drive 80 to 90% of the direction of the NASDAQ. Always remember that, because if the market's going to crash, always remember, watch that NASDAQ, watch those six generals, because when they start cracking, that's where you're going to find the crack. It's going to take the whole market down. You got to be watching those every day, and which we do. So again, Amazon, it was pulled back today, and Google pulled back, and then all of a sudden they try to push Nvidia up a little bit, and Microsoft, and again they're trying to rotate, but it wasn't any success really. There wasn't nothing there, so that's not doing well. But the banks is the one that I'm really concerned about right here. I'm trying to pull them up for you. I'll get it for you in a second here. Okay, so let's get to. Oh yeah, here's another group you got to watch. You got to watch the consumer discretionary, and you got to watch the consumer staples. Those are really important too, because the consumer, you take the discretionary like Tesla and Target, Home Depot and McDonald's. They like low yields, but yields are going the opposite way. So discretionary stocks are very, very important. That's a big part of our economy. The leisure stocks, which is discretionary, our casinos. As a matter of fact, we're in CCL, RCL, and again, these cyclicals, they love low rates, but that whole group can blow up. So this was quite a thing in the banks. Again, I'm trying to find the banks. If I can get them here, I should have got them ready for you before, but see if I can find them, Willie, where we put them. And the banks you got to really worry about, because again, that yield curve pushing out like that is very, very scary. So that's not a good thing. All right, I don't think I loaded them. Yeah, I thought I loaded them. I guess I don't have them in here. Okay, here we are. Okay, so JP Morgan, pulling back today. And I told everybody today to watch these banks, because, again, these banks, in the financials, yes, they do good on high yields. They make more money. There's no question about it, But at the same time, our economy's so weak that with bankruptcies, with people, they can't make their car payment, their truck payment, they're way behind on their credit cards. And with that announcement yesterday, You got credit cards going up. So anybody that tells you, okay, when yields are going up, banks do better. That's true. But you got to be very careful if you're going to go in and buy banks on that. Because on the other side of it, we have so many delinquencies in credit cards and auto loans and mortgages and so forth that, and just as an example, JP Morgan got hit hard today. And everybody was saying on Wall Street, oh no, buy the banks today, buy the banks, right? Now they were supposed to do well today, but they didn't. They didn't, okay? Because again, as I said, you got a lot of delinquencies going on. Citi, that pulled back today. Bank of America, these are all pulling back. These are stocks that's supposed to be doing well because of higher yields. So my whole point, what I'm trying to get across today, I don't think I'm doing a good job because I can't find my stocks, is that yesterday was a disaster. Forget that stupid memorandum of understanding. It's not going to work. In one hand, we have the real disaster going on when the new Fed says he's going to raise rates. And it took a big chunk out of this market. And then today, what we see happening, okay, is the banks starting to fall apart. And then we're seeing a rotation with the tech, what we call the generals, that drive the whole NASDAQ up 700. Everybody's celebrating. Oh, look at the NASDAQ up 700. Are you kidding? Watch what happens to that in the next couple of days. So that was a real mess, okay, yesterday. When he announced that, I have no idea why he did that, especially when Powell was supposed to get, remember they tried to fire him. So anyways, that's where we stand right now. So the whole point with this agreement is not going to work. Not going to work. Gasoline's going to go right back up, and the timing couldn't be worse for them to announce, okay, a rate, we're going to start raising rates. I just think this is setting up for a real big correction. You know, I could be wrong, but I think the timing could have been worse. Because if anybody thinks that Iran's going to keep this deal and gasoline prices and oil prices are going to keep going down, you got to be nuts. It's not going to happen. So I think this was a terrible thing he did yesterday. But if you know how to short stocks, it doesn't matter, does it? Doesn't matter. So anyway, so that's what went on today, and most people didn't pick up on it. And they're just going along, oh, wow, look how strong the market is. We got the NASDAQ. Everybody looks at the NASDAQ, right? Oh, look at that, up 700 points. Well, always remember, watch the 6 generals. And I gave them to you. That's where the crack's going to show up. That's where the whole correction's going to show up first. And watch that yield curve. What he did yesterday makes the yield curve even worse. Pushes us out from minus 44 to now minus 50. We got to be at plus 150. That's where we got to be. So this is, the market's getting to a point now where you really got just a handful of stocks left that are driving the whole market, holding up the whole market. Just a handful of stocks. A couple of them crack. It's over. And you got to follow the institutional money. Because if you follow the institutional money, you know exactly when this market's going to crack. You're going to know. You don't have to guess at it. You'll know when we're going to have a huge correction or even a crash. So how long can they keep this going, this market? Well, for a long time. If they just keep on doing what they're doing, you know, every day, hey, we got a good deal. We got a new deal with Iran, and oil's going to come down, and gasoline's going back to $2. You know, they keep this thing going for a while. But under the hood is the real problem. And so the only thing I can tell everybody, like I told my gang, watch the 6 generals. Those are the stocks. Everybody says, well, if the market's going to crash, how do I know? Watch those 6 stocks. It's going to happen in those 6 stocks, okay? All right. I will see you on the charts.